Welcome back to the Wall Street Podcast. Today, we're doing a deep dive into a recent Goldman Sachs research report on China Telecom. That's ticker 0728 on the Hong Kong Exchange. The report came out August 15th, 2025, titled Strength Across Margins, FCF, and Growth, Buy with TPHK $7.02. So our goal here is really to dissect Goldman's take on China Telecom's Q2 performance, their efficiency, and the outlook. We'll pull out the key insights for you. Let's kick off with the main highlights from the report. China Telecom seems to have outperformed its peers in the second quarter.
Definitely.
EBITDA grew 5.2% year over year, net profit up 7.1%, pretty solid numbers.
Very solid. And what really stands out is the free cash flow.
Right, that 14% year over year dump.
Yeah, Goldman notes that was helped significantly by a drop in capital expenditure, their Capex.
So spending less, freeing up cash?
Exactly.
Yeah.
And it wasn't just the FCF. The report also highlights significant margin expansion.
Yes, the efficiency point.
Right. Operating expense growth was kept quite low, only 1.4% year over year. Meanwhile, their service revenue grew 2.1%.
Okay, so revenue growing faster than costs.
Precisely. And that difference led to a full 1 percentage point expansion in the EBITDA margin just in Q2. That signals some, effective cost management internally.
And good news for shareholders too, right? The dividends?
Yes, absolutely. The first half 2025 dividend per share increased 8.4% year over year. It's RMB 0.1811.
And the payout ratio?
That climbed too, up to 72%. That's a 2 percentage point rise year over year. And the company apparently reiterated its commitment to, steady dividend growth going forward.
Okay, let's pivot slightly. There's a point in the report about rising accounts receivable, particularly from government customers. Now, usually that might suggest a strain on cash flow. So how did Goldman Sachs reconcile this with projecting largely stable free cash flow?
That's a really important question. So when you have delayed payments, especially from, say, government entities, your accounts receivable pile up. It's money owed but not yet received.
Which means setting aside more for potential bad debts.
Exactly. That increases the bad debt allowances, which directly eats into the reported net profit.
Okay.
But Goldman's projection for stable FCF, despite this, hinges heavily on that reduction in capital expenditure we mentioned earlier.
The lower Capex again.
Right. Think of it like this. They're managing their cash flow not just by collecting faster, but by significantly cutting back on their big investments for now. So that reduction in spending is what primarily stabilizes the free cash flow, even with those slower collections. And that, in turn, helps support the dividend payout.
Makes sense. It's a balancing act then.
Pretty much.
Okay, let's unpack another concern some investors might have. Expense control sustainability. If China Telecom has already been quite efficient, is there really much room left for further cost reduction? How can they keep expanding margins and growing profit?
Well, what's interesting here and what the report points towards is a strategic shift. It seems China Telecom isn't solely focused on, just slashing costs anymore.
So what's the new focus?
They're prioritizing high-quality revenue streams, the kind with better inherent profitability. It's less about just chasing sheer scale, more about focusing on these, more lucrative business lines.
I see. So shifting the revenue mix towards higher profit areas.
Exactly. And that's expected to help sustain their margins, even if the opportunities for direct, deep cost cuts become more limited. It's about efficiency through a better type of revenue, not just austerity.
Right, a more strategic approach to profitability. Okay, so Goldman maintains a buy rating. They cite strength in cloud and enterprise, plus valuation. What are the key catalysts driving this positive view? And conversely, what are the big risks investors need to watch?
Good question. The main catalysts Goldman sees are really tied to broader national trends in China, specifically the big push for artificial intelligence development and the build-out of national cloud infrastructure.
Areas where China Telecom is positioned to benefit?
Precisely. They're a major player there, so it aligns well with government policy and offers significant growth potential.
And the risks?
Well, the report doesn't shy away from those. Key risks include intensified competition in the industry. That could really pressure mobile ARPU, the average revenue per user.
Competition is always a factor.
Always. Then there's the question of returns on their huge 5G investments. Will the returns justify the massive capital outlay? That's still somewhat uncertain.
A common concern across the industry.
Indeed. And finally, the risk of losing market share in their traditional wireline broadband business, which is also highly competitive.
Yeah.
Any of these could potentially erode profitability if not managed well.
Okay, so pulling this all together for our listeners, for you, these insights aren't just numbers in a report. China Telecom's strategy and performance directly impact things like the quality and maybe the price of your phone and internet services.
Mhm. And the speed of the 5G rollout in your area.
Right. Plus, the underlying cloud infrastructure that powers so many digital services you use every day, streaming, work apps, you name it.
And of course, the financial health and dividend strategy of a major telecom like this has broader economic implications, whether you're an investor or just a consumer in that market.
So, digging into reports like this gives you a much deeper feel for market dynamics and corporate strategy. And here's something to think about. How might China Telecom's apparent shift towards prioritizing profitable revenue rather than just sheer scale or market share influence other telecom operators globally? Could this reshape the future of digital services you rely on?